Our Ethereum ETF tripled in just 4 months. Our 2024 investment of the year was Bitcoin, but silver has been the silent super performer. So is copper. So we're going to talk about all this and more, including how you can mitigate capital gains taxes, how you can even invest there, because you're not going to get these options in your employer-sponsored retirement account. And all this and more, including the forward outlook, like what's going to happen going forward. Should you be capturing gains now, or should you have game on for even greater gains? Maybe it's a little bit of both. All this and more in my free video conference. Be sure to share this with your friends. Let's get everybody empowered with the life math that we all should have received in high school. And you can also listen as a podcast on Substack. Both places, YouTube and Substack, Natalie Pace. Please like and subscribe so that you get notification whenever I do these free video conferences. In fact, on October 29th, I'm going to be interviewing one of the titans of the gold and copper industries, Rob McEwen. Okay, we'll get started in just a moment. Okay, we're going to get started now. And I am showing a PowerPoint presentation. So if you're listening to this, I do encourage you to go over to youtube.com/Natalie Pace, where you can actually see some of these charts that I'm referring to. So the first thing is we're going to talk about how crypto, copper, silver, gold are all more magnificent than the Magnificent Seven. So we've all been hearing about NVIDIA and AI and quantum and all of these hot things, right? And what you don't realize is that this year, actually, the hot performers have been the safe havens. Now, Magnificent Seven is still super hot. You definitely want large cap growth. We actually are adding in an extra hot slice of Magnificent Seven in our sample pie charts, but it's not the only thing that you should have. And you also want to learn about how to avoid capital gains because obviously NVIDIA has been a superstar. And if you purchased it a few years ago and it's gone up 10 times, you may want to capture some gains. And you definitely would like to do that within a vehicle that allows you not to have to pay capital gains taxes. We'll talk a little bit more about that in just a moment. So again, I already said this, that our Ethereum ETF tripled in 4 months. Bitcoin was our 2024 investment of the year, but gold and silver are hitting highs, as is crypto. So should you buy now, right? Or is there a better strategy? We're going to talk about that in just a moment. And that's going to include what's the future going to hold and what can we learn from the past that will tell us what the future might hold. So this is what has performed this year to date, as of September 19th. First Majestic Silver, which is an individual company, it actually popped a few days ago and it's up 121% now. Silver is the next, just silver, like the silver ETF SLV is up 50%, copper, followed by gold, Bitcoin, and then communication services, which is largely Magnificent Seven, industrials, information technology, Magnificent Seven. And then you'll see at the bottom, it's utilities, consumer staples, real estate, etc., and healthcare and energy being the absolute worst performers. Now, the reason I want to mention that is that those are what's usually in our value funds. So if you're a conservative investor and you're only invested in bonds and value funds, you are not participating in the great gains on Wall Street. And you probably could be earning better income. So we're going to talk about that as well. But let's first dive in more to the super performers. So the question here, will gold and silver continue to soar? What could ruin the party? What is the best strategy? How can you mitigate capital gains? So the first thing, let's talk with the capital gains. If you have an employer-sponsored plan, they probably don't have a gold or a silver ETF for you to invest in. The only way to do it is for you to have your own individual retirement account. Now, if it's a Roth IRA, that's really great because so all individual retirement accounts, you do not pay capital gains taxes. But the additional benefit of the Roth is that when you go to retire, when you pull the money out, you don't pay income taxes either. Now, Peter Thiel, purportedly, according to ProPublica, has over $5 billion in his Roth IRA. So these are some of the secrets of the 1% that we all could be learning a few tips from, right? So that's the first thing I would say is that you don't want to just have the employer sponsored account. You don't want to be just sold into the idea it's pre-tax. Of course, you want to get free money. So if your employer matches, match up to that. But there are other retirement accounts that you should be considering, including a Roth IRA and potentially a health savings account. That one could actually save you a lot in healthcare premiums. A lot of people think, oh, my employer covers it. You don't realize that premium is getting taken out of your W-2. You better look at that. So you could save thousands every year in healthcare premiums. Doesn't mean you get rid of the healthcare plan. And have the health savings account, which eventually you can start investing and you get a tax credit. So you pay less to the tax man. So that's just one tip I wanted to throw in there. I cover that more in my book, The ABCs of Money. Be sure you're getting the sixth edition. So again, I just talked about how we can stop making the tax man rich and how we can invest because you aren't going to be able to invest in crypto or gold or silver in your employer-sponsored plan. And that's how your employer-sponsored plan, whether it's a 401k or RSP in Canada or an IRA TFSA in the US and Canada can work together, right, to become part of your nest egg. Also, same thing about crypto. A lot of people are still buying crypto in their crypto wallet, subject to capital gains if you want to capture them. And if you have that now, you do have the opportunity only for Bitcoin and Ethereum. There are Bitcoin and Ethereum trusts. I would still be very, very cautious about the actual fund company that I buy it from, but you can purchase these in your IRA. Anyone, I have like a Schwab IRA and I can purchase it in there. So this is really good. And the exact example I used of our Ethereum ETF, which is ETHA, it's an iShares trust, that was the one that tripled over since April. So let's talk a little bit more about copper. We are using Peru as our small mid-cap value replacement fund. So again, we talked about how the industries or the sectors that are in our value funds in the US that they're heavily indebted, they're slower growth, and oftentimes they're even paying less income. That Peruvian ETF is paying a yield of 4.1%. And it's got much higher growth. In fact, I included that on that performance chart. It's right up there with silver. It's above gold year to date in terms of returns, and it's offering that 4% yield. So again, these are things that we want to be thinking about. We are using value replacement funds, so we get country diversification. Oftentimes, we're getting up to twice the amount of income. In some cases, we're getting higher credit quality. So I would just say this is something you want to be aware of. Obviously, that's going to be easier to purchase again in your own individual retirement account. So you kind of want to have both the employer sponsored account where you get the free money from the employer, but limited options, no financial freedom, no Peru, no gold, no silver, no Bitcoin, no Ethereum, and your own retirement account where you may even be able to shoot the moon on it, capture gains, and then when you retire, no income taxes. Also, I wanted to make everybody aware that I am going to be interviewing Rob McEwen on October 29th and email info@nataliepace.com if you'd like to join us live or if you want to receive links to watch the interview back on YouTube or listen on Substack. I do encourage you to subscribe on YouTube and Substack so that you're notified whenever it goes, gets published as well. Now, Rob McEwen is a veteran in this industry. He took Gold Corp from 500 million to over 8 billion. And then he decided to do it again with McEwen. He has McEwen Mining, and he's also the chairman and chief owner of McEwen Copper. So we'll be talking about both copper, gold, and silver because he mines all of these things. The copper is more exploration at this point, but it's on track and doing great. So far, so good. So, safe havens typically do really well when people lose confidence in the economy or in the dollar. Now, the VIX is very low, which means people are happy with all the returns they're making on Wall Street, but it changes in a snap. In April, it was high. And we saw that stocks dropped 20% between the February 2025 high and the April 8th, which was the low. And by the way, what happens at the beginning of the drop is that the safe havens get pulled down. So we did see that ETHA in April 8th, it was $11. It's now 32. So it's really important to be aware of this. Now, if you have a properly diversified plan, you have enough safe, you have liquidity. If stocks drop that much, you would be in a position to say, I wonder if I should be buying more low, right? Instead of, oh my God, did I lose a lot of money? So we're going to show you what that sample pie chart looks like. But I think that's an important piece. I'm also going to tell you what a good strategy for buying into some of these safe havens if you don't already own them, rather than just, buying high. So consumer sentiment is a concern. It's historically low. And as you can see here, these gray lines are recessions. It's highly correlated with recessions. So this is something to be aware of and a little bit cognizant, maybe even slightly worried about. Again, if you're worried about the economy or about things heading south, the best strategy is overweighting a little bit more safe. Just act a little older. Don't try market timing all or nothing, because clearly that would not have worked over the last 5 years. Stocks have doubled. The S&P 500 has doubled over the last 5 years. So this is from Liz Ann Saunders. She's a managing director, chief investment strategist at Charles Schwab, from her May 30th this year podcast. She said, I feel sometimes like we're in the midst of a late 90s kind of market where the tech bubble kept going and going and nothing seemed to stop it until it really stopped. Now, she's a lover of data. And if you look at this chart, the NASDAQ Composite Index fell 78% between March of 2000 and October of 2002. It took 15 to 16 years to get back to over 5,000 that it saw in March of 2000. So clearly, and by the way, people using our pie chart strategies, they earned gain in the dot-com recession. They earned gain in the Great Recession because bonds were doing well. Now, bonds are not doing well this time, but you still want to keep a percentage equal to your age safe. And just FYI, our fixed income strategy on the safe side, no paper losses, and it's more of a true income because there aren't the paper losses and we're getting a good yield on it. So I do encourage you, I'm going to tell you a little bit more about that, but this is why it's important to always keep a percent equal to your age safe, because as you can also see from this chart, the announcement of the recession comes after the losses are already embedded. So most of the losses from .com occurred well before 9/11. And again, you weren't notified about that. So it's important, I did, and just FYI, if you want to look at the chart, I was telling people on Christmas 1999, that it would be a good idea to rebalance and to get age appropriate and properly diversified. So let's keep moving on because there's so much to cover in this one. So here's another chart that just shows how expensive equities are right now. And the only time when stock prices have been higher was actually in the dot-com recession. They're higher today than they were in the Great Recession. Great Depression, much higher than the Great Recession. And again, stocks dropped 55% in the Great Recession, took many years to come back to even. So when equity prices get high, it means volatility. So we saw a 20% drop in 2 weeks, between February and April. We saw about 35% drop in 1 month in the pandemic. So we are going to see these really aggressive moves whenever equity prices are so high. Nvidia dropped dramatically in April. It's up double since April. So again, in the beginning of a correction, safe havens will typically drop with stocks and then they decouple. So this chart I'm showing you here is SLV from April of this year. And you can see that it really dropped and then it is far outperforming. And that can happen. ETHA here, I showed that when Ethereum really dropped down to the ETHA fund was just $11 a share. And yesterday it was at 32. Also, I want to make you aware, because we're going to talk about what's expected to go happen going forward, of Bitcoin halving events. So the last, we just had one in April of 2024, but the two prior to that had very strong correlations. And the year after the halving event, they hit their high, and 2 years after, it was a crypto winter. So we are hitting the highs here a year later from the most recent halving event. And if this goes as historical trends have been going in the last two prior halving events, then maybe April of 2026 might be another crypto winter. So just be aware of these things. And it's one of the reasons why we use it as a hot slice instead of the whole strategy. So that when things are at an all-time high, that you can sell high. Like Ethereum, the Ethereum ETF went all the way down to 11, but Ethereum itself dropped very low in April as well. So it's just really important to have a strategy that helps to keep you on the right side of the trade, helps you to capture gains. It's not market timing or all or nothing. Set it up properly, age appropriate, diversified plan, and rebalance once, twice, or three times a year. We'll talk a little bit more about what that looks like as well. So I wanted to show you why copper is called Dr. Copper. So as you can see from this chart, this is another copper fund that in the Great Recession, so the bottom, copper will go further faster before stocks hit their bottom. So copper hit its bottom in November of 2008 in this particular fund. It was $30 a share, and it went all the way back up to $80 a share in less than 18 months. When the Dow Jones Industrial Average dropped in the Great Recession, it lost 55%, took over 5 years to crawl back to even. So it's very, very cool to understand that, or crucial to understand that copper can be the first thing to drop when the economy slows down, but it will decouple from that, and it will shoot back up because the first thing that happens when the economy starts growing again is rebuilding. And copper is a tool of rebuilding in almost every way. From everything from our electric vehicles to our homes and much, much more. So that's just something to keep cognizant of, and that's another reason why we do strongly suggest that you are using the pie chart system. And again, if you'd listening to this on a podcast, we are showing that pie chart system on YouTube, but you can also email us at info@nataliepace.com or attend our retreat. You can get access to your own free web apps where you can personalize your own pie chart. So keep a percent equal to your age safe. We're overweighting safe because stocks are really expensive. Consumer sentiment is very low. Debt is outlandish. And then diversify the other into 10 funds. Now, most managed accounts have like 18 pages of holdings, and I do a lot of unbiased second opinions, and they really are not diversified. They'll say, "Oh, you're so diversified. We're using modern portfolio theory," but they're really not. And a lot of times when I'm evaluating those managed plans, what they've got is large cap growth, maybe large cap value, and a boatload of bonds, and maybe a small amount of small caps. They have, and if they do have something hot, it might be in something like real estate that's not that hot, might be one of the worst performers, or even oil or energy. So it's important to think about these things and to be the boss of your money. So why Peru instead of Chile? Because Chile is the top producer of copper and Peru's number two. The reason is that Chile actually has nationalized its copper. So you're getting a greater GDP growth in Peru. You're getting a 4% yield in the Peruvian fund. It's been one of the top performers of the year as well, with over 50% gains. So really, almost 50% gains, sorry, this year. Now, will copper prices go higher? And again, they're very high right now. The demand is expected to go down a little bit, not drop. Of course, if there is a recession, it could go down a lot. But because the supply is still constrained, the prices are expected to remain high and go higher, not dramatically higher, but higher. So that's something that's positive for Peru. But again, if we actually hit a recession, and you want to be aware of that before it's a headline because they're very late. There will be in the midst of the recession. Stocks may drop 35, 40, 45%, and then they call the recession, after all of that has happened. So you don't want to wait for the headlines. You're going to be late. A Silver Majestic was an individual company that we identified. It is up 121% year to date. Now, should you take your gains? What's the forward outlook? Is investing in an individual company right for you? And I would say that for most people, unless you really want to start learning the tools that hedge funds use, the analytical tools, investing in an individual company is not a good idea because it's hard to be on the right side of the trade, right? We always chase returns and then we never want to sell high. So, and if you are going to do it, I would say Vegas money, not your nest egg. Now, the other side of it is, should you keep on to it? And that's where the pie chart strategy can help us. So if we ever have a slice of something that's become two slices, there's no harm in selling high and trimming it back to one. It doesn't have to be all or nothing, right? I'll talk a little bit more about First Majestic at the end of this video conference and this podcast. But what I liked about it is the year-over-year sales growth is just outlandish. It was over 100% when I first listed it. It's still very strong going forward. The company has their own mint, and they mint these collectible silver coins. This one that I'm showing on the screen is Chinese New Year, the dragon, but they also do political ones that are probably pretty popular. So the last thing I want to talk about is that value funds, target date retirement funds, which is what a lot of people have in their retirement accounts, and bond funds. Are you paying thousands every year just to lose money? If you have a managed account, you may be paying 1% in fees. That's a lot of money if you add it up, right? And I look at a lot of managed accounts. I don't manage money. I do unbiased second opinions. I stay on the education side. But a lot of times what I'm seeing is that what you're being told and what is actually happening are two different things. On the brokerage statement, it tells you the truth. But what you're told sometimes by the broker salesman is that you're earning 5 to 7% income. But they're not telling you about the fees and the paper losses. On the brokerage statement, it will add it all up for you. And the ones that I've been looking at, less than 2% total return, or even negative returns, depending on how much paper losses you have. So really important to know what you own and why, especially if you're a conservative investor, because bonds lost more than stocks did in 2022. They lost again last year. They are illiquid. It's hard to resell them. People say that, oh, I'll just hold it to term. Have you looked at the terms of them? Many of them are 35 years, 50 years. I saw a junk bond that was an 85-year term. Are you going to live that long, right? And in the meantime, it's not just a paper loss. There's nobody that's going to buy that from you, right? So oftentimes the minute you purchase it, it's worth much less than what you paid. And there's nobody on the other side of the table that wants it. So again, you really want to know this particular target date retirement fund that I'm showing you on YouTube. It's lost money over the last 5 years. So you're hearing that stocks are hitting an all-time high, and you might be thinking, oh, my retirement fund is fine, and you're filing the statements without looking at them. Well, you might have actually lost money if you selected the wrong thing in your allocation. So again, you really want to know exactly what you want and why. And now is the time because there's still some liquidity that fix the roof while the sun is still shining. You don't want to wait for the storm to fix the roof, right? Then you've got to clean up everything and rebuild everything, and that could take years. Fix the roof while the sun is still shining. Email us at info@nataliepace.com, whether you come to the retreat or get an unbiased second opinion. Now is the time to be the boss of your money. Okay, so paper losses abound on many fixed income strategies. They can become real and substantial. There are no paper losses on our fixed income strategies. We're earning better income as a result of that, but also market income anyway. Many older companies, people are not aware, are carrying very high debt and may even have very low credit quality. Over half of the S&P 500 is at or near junk bond status, including a lot of energy companies, banks, and most companies founded over 50 years ago, last century. Remember that the higher the dividend, the higher the risk. So you can't just say, I'm going to earn income on this without understanding, are you going to lose principal? Okay, really important. So I'm showing you two kangaroos fighting because we actually use a value replacement fund of Australia. You get a better yield and better credit quality for the large cap value funds that are in the US. So this is a sample again of a 21st century time-proven wealth plan. You can get safe, hot, and protected in one easy plan. Again, always keep a percent equal to your age safe. Overweight safe if you think there's a reason that stocks could go down, and then diversify the at-risk side in 10 different funds. Now, we will teach you how to do this October 11th through 13th in our online Harvest Financial Freedom Retreat. You can attend from your living room, no travel, no lodging costs. And we record it so you can actually watch it back and keep continuing up that path of wisdom. And you should come away with the tools that you need to be the boss of your money and to set up your plan properly. Also, I do offer private coaching and an unbiased second opinion. So if you have a lot of money at stake, why not know what you own and what's the great news about it and the things that you might want to be dumping, right? So through, get pricing and information about my unbiased second opinion, I do it in my private coaching program. Again, info@nataliepace.com, or you can call us 310-430-2397. Now, I'm also hosting a fixed income without paper losses masterclass on September 18th. That's the Saturday after the retreat. You do need the retreat because we spend one full day on what's safe at the retreat. And you need that foundation of wisdom in order to go into the master class. So you'll need both. We do offer a bundling discount if you want to attend both. So the last tip I'm going to give you is that if you want to start investing in these hot areas and you don't have anything, dollar cost average if it's trading at an all-time high. If it's trading pretty low, like clean energy is, then maybe you can go ahead and buy your slice worth. But I would not just buy a full slice worth of, Ethereum, gold, silver, etc. I would dollar cost average into it, and I might take a year or two to do that. If you don't know about dollar cost averaging, AI is pretty good at explaining it for you. Or again, we talk about it a lot at the retreat, and I certainly mention it in my ABCs of Money sixth edition book. So another thing that's key to a successful wealth strategy is you do need to rebalance your plan once, twice, or three times a year because it needs to remain age appropriate and properly diversified, right? When stocks have doubled in the last 5 years, if you haven't looked at them, you have too much at risk in stocks and you want to sell high. It's not all or nothing. It's just age appropriate, properly diversified. So now is a perfect time to do that because stocks are still trading at an all-time high. So again, you can personalize your own sample pie chart free. Take an investor IQ test, take a rebalancing IQ test free, 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 and email info@nataliepace.com for any of this. Just stick whatever it is you want in the subject line. We also offer free video conferences, free blogs, and of course, if you want to join me at the retreat, you want to be sure to come. I have a new blog that talks a lot more about all the things that I mentioned in this video conference. So if you go to nataliepace.com/blog, you should get it. It's called Crypto, Copper, Silver, Gold, More Magnificent Than the Magnificent Seven. And again, go to nataliepace.com and there's the blog there. It's the first blog you see. At the end of each blog, I also have a list of prior blogs. So if you just were to do a find on crypto or copper, you'd see other things, even our Peruvian, why we like Peru, why we like Australia, that sort of thing. And on the homepage, you can also access the flyer for our Financial Freedom Retreat. Again, it's online, October 11 through the 13th. And you could even, if you're in Southern California, join us for our financial freedom game this afternoon on the beach at 4 p.m. Pacific. Email info@nataliepace.com to join us right away because that's only coming up in an hour or two. We have a virtual of that free. So email if you'd like that. Thanks again for joining me. Have a lovely day. And, we really want to support you building personal wealth, not riding the Wall Street roller coaster, not chasing gains, but understanding what an age appropriate, properly diversified plan that you rebalance once, twice, or three times a year looks like, and just how much fun it can be when you do it right. Time to get the life math that we all should have received in high school. Thanks again. Natalie Pace signing off.